Good morning to you. Today, we're diving into the world of finance, specifically a strategy called the bear put spread. Don't let the name intimidate you. It's all about potentially profiting from a stock's decline, and we're here to break it down for you. In essence, the bear put spread is a bearish options trading strategy. That means it's designed to make money when the price of a stock goes down. And here's the exciting part. It's considered a capital gain strategy. This means that if all goes according to plan, you could potentially earn a profit when you sell the options. Now, how does it work? Imagine you're a bit pessimistic about a particular stock. You believe it's headed for a dip in the near future. With a bear put spread, you're essentially placing a calculated bet on this downward movement. But remember, investing always involves risk. It's crucial to understand the ins and outs of any strategy before jumping in. So, stay tuned as we unravel the mysteries of the bear put spread. Let's talk Greeks. No, not the alphabet kind. In the world of options trading, Greeks are like your financial compass, guiding you towards potential profits or warning you of potential storms. They are the unsung heroes that help traders make informed decisions. First up, we have Delta. Think of Delta as the speed of your options. It measures how much an option's price is expected to change for every $1 move in the underlying stock. Essentially, it tells you how sensitive your option is to the price movements of the stock. A higher delta means your option is more sensitive to price swings. This can be both an opportunity and a risk, depending on the market conditions. Next, we have Theta. Theta is all about time decay. It tells you how much value your option is expected to lose each day as it gets closer to its expiration date. The closer you get to the expiration, the faster the time decay. Like a ticking clock, Theta reminds you that time is money in the options market. Managing Theta effectively can help you minimize losses due to time decay. And finally, we have Vega, the volatility guru. Vega measures how much an option's price is affected by changes in the volatility of the underlying stock. When the market is volatile, Vega becomes a crucial factor to consider. A higher Vega means your option is more sensitive to market jitters. This can lead to significant price changes, making it essential to keep an eye on market volatility. Understanding these Greeks is key to navigating the bear put spread effectively. Each Greek provides a different perspective on how your options might perform. They provide valuable insights into how your position might behave under different market conditions. By mastering the Greeks, you can make more informed and strategic trading decisions, ultimately enhancing your trading success. Let's bring the bear put spread to life with a real-world example, shall we? This strategy can be particularly useful in a bearish market scenario. Let's say you've been following Apple, AAPL, closely, and you have a hunch that its stock price might take a dip in the coming weeks. You believe that the current market conditions and recent news about the company suggest a downward trend. To implement a bear put spread, you would buy a put option with a higher strike price and simultaneously sell a put option with a lower strike price. This combination allows you to limit your potential losses while still capitalizing on the expected decline. Both options would have the same expiration date and be based on AAPL stock. This ensures that the timing of the options aligns perfectly with your market outlook. For instance, let's say AAPL is currently trading at $150 per share. This is your starting point for setting up the bear put spread. You could buy one put option with a strike price of $145 and sell one put option with a strike price of $140, both expiring in a month. This setup creates a spread that defines your potential profit and loss. If AAPL's stock price falls below $145, your bought put option would gain value, while your sold put option would lose value. The net effect of these changes determines your overall profit or loss. This difference in value could potentially result in a profit for you. The maximum profit is achieved if the stock price falls to or below the lower strike price of $140. Of course, this is a simplified example. In reality, there are many nuances to consider. The actual outcome would depend on various factors, including the movement of AAPL's stock price, the premiums paid for the options, and the time until expiration. Additionally, factors like implied volatility and market sentiment can also play significant roles in the success of your bear put spread strategy. Entering and exiting the den, a step-by-step guide. Now that we've covered the basics, let's walk through the steps of entering and exiting a bear put spread position, shall we? This strategy can be particularly useful in a bearish market, where you anticipate a decline in the price of the underlying asset. To enter the trade, you would place an order with your broker to simultaneously buy the higher strike put option and sell the lower strike put option. This combination allows you to limit your potential losses while still benefiting from the expected price drop. This is typically done as a single transaction called a spread order. By doing so, you ensure that both legs of the trade are executed together, reducing the risk of partial fills. Once your order is filled, you'll hold the bear put spread position until you decide to exit. Monitoring the market and your position is crucial during this period. There are a couple of ways to do this, each with its own set of considerations and potential outcomes. Closing the spread. You can close the spread by selling your bought put option and buying back your sold put option. This action locks in any gains or losses and effectively ends your position. This effectively unwinds your position, making it as if the trade never existed in your portfolio. Exercising your options. If AAPL's price falls below the strike price of your bought put option, you can exercise it to sell 100 shares of AAPL at the strike price. This can be a strategic move if you believe the stock will continue to decline. You can then either hold on to the shares or sell them in the market. Holding the shares might be beneficial if you expect a future rebound. The decision of when and how to exit your position depends on your individual trading plan, risk tolerance, and market conditions. Always review your strategy and stay informed about market trends to make the best decision. The two sides of a coin. Pros and cons. Like any investment strategy, the bear put spread comes with its own set of advantages and disadvantages. Let's weigh them up. On the plus side, the bear put spread offers limited risk and defined profit potential. Your maximum loss is limited to the net premium paid for the spread, while your maximum profit is capped at the difference between the strike prices minus the net premium. Moreover, bear put spreads can be a capital-efficient way to profit from a bearish market outlook. This is because you're essentially selling one option to help offset the cost of buying another. However, it's important to be aware of the downsides as well. One major drawback is the limited profit potential, as mentioned earlier. Additionally, bear put spreads require a significant move in the underlying stock's price to be profitable. Furthermore, time decay works against you in this strategy. As the options approach their expiration date, their value erodes, potentially eating into your profits. Mastering the bear. Put spread. Key takeaways. That brings us to the end of our deep dive into the world of bear put spreads. Let's recap the key points, shall we? The bear put spread is a bearish options trading strategy designed to potentially profit from a decline in a stock's price. It involves buying a put option with a higher strike price and simultaneously selling a put option with a lower strike price, both with the same expiration date. Understanding the Greeks, delta, theta, and vega, is crucial for managing your bear put spread effectively. These metrics provide insights into how your position might react to changes in the underlying stock's price and volatility. While bear put spreads offer limited risk and defined profit potential, it's important to remember that time decay works against you. Therefore, careful planning, risk management, and a solid understanding of the strategy are essential for success. As always, it's crucial to conduct thorough research, consider your risk tolerance, and consult with a financial advisor before making any investment decisions.